43 days, that's all it took. 43 days for silver to go from $70 an ounce to an all-time record high of $121.67, the fastest, most violent rally in the history of the white metal. People were calling it the greatest precious metals bull market of the modern era. Analysts were screaming about $200. Reddit was on fire. The silver community, the stackers, the bugs, the believers, they finally felt vindicated after years of being laughed at. And then, in less than 30 hours, silver lost 33% of its value. 33% gone, vaporized. One of the worst single-day crashes in silver's entire history. Worse than anything we've seen since the Hunt brothers collapsed in 1980. And right now, as you're watching this video, silver is sitting around $72 an ounce, bouncing between $69 and $75, like it's stuck in quicksand. Everyone's asking the same question. What is happening? Why can't silver get off the floor? Today, I'm going to tell you the real story, not the sanitized version, not the be calm, stay diversified version. I'm going to tell you exactly what happened, who benefited, and most importantly, what it tells us about where silver goes from here. Because I believe the answer to silver's current paralysis will genuinely shock you. Going into 2026, silver started the year around $70 an ounce, and that was already a stunning number. Just a year before that, silver was sitting in the low 30s. The metal had already more than doubled through 2025. Silver rose more than 162% year over year by early 2026. That's not a rally. That's a generational move. Why? Because the fundamentals finally caught up with the narrative. Silver's industrial applications, particularly as a paste used on solar panels to collect and transport electricity, had become a critical demand driver, and geopolitical policies were tightening supply at the same time. We were already in a structural supply deficit. 2026 marked what was shaping up to be the 6th consecutive year of supply deficits in silver. 6 years. Let that sink in. Demand exceeding supply for 6 straight years. And then January happened. Silver started the year near $70 on January 1st and surged to an all-time nominal high of 121.67 on January 29th. That's a 74% gain in less than 1 month. In a single month. That kind of momentum doesn't happen in normal markets. That's a mania. A beautiful, intoxicating, dangerous mania. Gold had also reached its own all-time peak of $602 per ounce in late January, representing a stunning 29.5% gain for January alone. Everyone who had been dismissing precious metals for the last decade was suddenly very, very quiet. January 30th, 2026. Mark it in your calendar. Because what happened that day will be studied in finance textbooks for decades. Silver crashed nearly 33% in a single trading session, plunging from above 120 wows per ounce to $76. One session. 36%, gone. Silver futures experienced their worst single-day performance since March 1980. What triggered it? There wasn't one thing. There were 4 things, all hitting at the exact same moment like a financial perfect storm. President Trump announced his intention to nominate Kevin Warsh as the next Federal Reserve Chair. Warsh is perceived by markets as a monetary hawk, hawkish Fed chair, stronger dollar, higher rates for longer. For silver, which had been running entirely on the fuel of dovish Fed expectations, the news hit like a sledgehammer. The Fed held rates at 3.5%, 3.75%, and revised its 2026 dot plot down to just 1 cut. And silver, which had run from $40 to $121 in roughly 14 months, almost entirely on dovish Fed expectations, faced a brutal repricing. The CME Group moved to a percentage-based margin system in January 2026, hiking maintenance margins to 15% for standard positions and up to 16.5% for heightened risk. What does that mean in English? It means that everyone who had been using leverage, and there were a lot of people using leverage at $120 silver, suddenly had to come up with more cash or get liquidated. Forced selling, cascading, automatic. The move is reminiscent of how past silver spikes ended, including in 1980 when regulators similarly ended the Hunt brothers' silver position by raising margin requirements. History rhyming loudly. The entire Reuters article that crashed the rare earth market was rewritten, and it turned out the reporting that sparked the selling was characterized by the Energy Department as false and relying on unnamed sources that were either misinformed or deliberately misleading. But the algorithmic traders didn't wait to fact check. They saw the headline. They sold. And by the time the correction came out, the damage was done. January 30th marked the final trading day of the month, when liquidity typically thins and price moves become exaggerated. Profit-taking after silver's parabolic 57% January rally created additional downward pressure. 4 triggers. One day. The most violent silver crash in 46 years. And here's the part that should make your blood boil. JP Morgan closed $10 billion in silver shorts at the exact market bottom, with all 633 delivery notices settled at that precise price. The exact bottom. Think about what that means. While retail investors were panicking and liquidating, the biggest bank on Wall Street was quietly closing out their short positions at the perfect moment. Convenient, right? Extraordinarily convenient. So here we are. Silver is hovering around $72, down nearly 40% from its all-time high. On March 20th, silver exchanged hands at $72.10 per ounce, still more than $38 higher than a year ago, but a brutal reversal from January's highs. Fortune. Why won't it move? Why is it stuck? There are three forces keeping silver pinned right now, and understanding all three is critical. Markets currently price in roughly 60 basis points of Federal Reserve easing by year-end, with the first rate cut expected in June. That's it. 2 cuts at most for all of 2026. That's not the "we're going back to zero" environment that sent silver to $120 until the Fed pivots more aggressively, or until inflation fears override the hawkish narrative. Silver faces a ceiling every time it tries to run. Non-yielding assets like silver are in a structurally disadvantaged position when interest rates stay elevated. Period. Here's the thing nobody wants to say out loud. The January rally was driven significantly by leveraged speculation. Retail traders, leveraged ETFs, futures speculators, they piled in. The daily rebalancing of leveraged ETFs and margin-triggered liquidations amplified the swings, particularly in silver. When those positions got forcibly liquidated in January, the speculative fuel that was driving the price got drained out of the market. Now, silver has to rebuild that speculative interest on a foundation that's been rattled. That takes time. It's not sexy, but it's real. This is the one that should keep you up at night. During the chaotic sell-off, physical premiums in Shanghai and Dubai actually surged, trading as much as $20 over Western spot prices. Read that again. While paper silver was crashing 33%, physical silver buyers in Asia were paying a $20 premium above the crashing paper price because they couldn't get their hands on the actual metal. China had locked down silver exports, creating problems for companies and sectors that need the physical metal for next-gen solar and AI technologies. Let me be very direct with you. The spot price of silver on your screen is a paper price. It's the price of a futures contract. It is not the price of the physical metal moving through the real economy, and the gap between those two realities is growing. Here's the thing the financial media won't tell you, because nuance doesn't get clicks. Silver being stuck at $72 is not a sign of failure. It's a sign of digestion. Think about what $72 silver actually represents. As of late March 2026, silver's gain over the past year is more than $36 per ounce. We're talking about a metal that spent most of the 2010s trapped below $20. $72 is not a floor. $72, from where we came from, is a ceiling that was supposed to be impossible. The biggest single-day crashes in silver history have almost always happened inside bull markets, not at the end of them. Volatility is the price of admission. Look at the structural picture. The fundamentals haven't changed. Fresnillo, the biggest global silver miner, cut its 2026 production guidance to 42 to 46.5 million ounces, down from the original 45 to 51 million, with its CEO citing operational challenges and a shift to narrower, lower-grade veins. Supply is shrinking. Mines are not keeping up. You cannot print silver. JP Morgan Global Research sees silver prices averaging $81 per ounce in 2026, more than double its average in 2025. Even the most conservative institutional forecasts point higher. The bull end of the spectrum? Gold Silver's Alan Hibbard would not be surprised to see the price increase by over $100 per ounce to $175 and beyond. And here's the macro wildcard nobody is talking about enough. Tariff policy. The initial Section 232 report didn't move forward with tariffs on silver, but it still left open the optionality of the government eventually returning to tariffs. If that happens, then the whole trade of moving metal to New York would likely revive, creating an environment where physical liquidity outside the U.S. gets tight. Tight physical liquidity plus a supply deficit plus industrial demand from AI and solar. That's not a recipe for $72 silver. That's a recipe for something much, much higher. Let me be blunt, because that's why you come to this channel. Silver at $72 is not a broken metal. Silver at $72 is a coiled spring. The January crash was not the end of the bull market. It was a margin-driven, algorithm-amplified, narrative-triggered purge of weak hands. And if history rhymes, and it always rhymes, what follows the purge is the real move, the one that shakes off the tourists and rewards the people who understood why they were holding silver in the first place. The shocking truth about why silver is stuck. It's stuck because a $72 price tag after everything that happened is actually remarkable evidence of underlying strength. It's holding. The floor is real. Technical analysis shows silver has found strong support at the 50-day exponential moving average near $70 to $71 per ounce, which coincides with historical peaks from late 2025. Hold resistance becomes new support. That's how bull markets work. The people who panic sold at $78 on the way down are the same people who will chase it at 110 on the way back up. Don't be that person. Now, I'm not your financial advisor. I'm not telling you to buy silver tomorrow morning. What I am telling you is this: the forces that sent silver from $30 to $121, the supply deficits, the industrial demand from solar and AI, the dollar concerns, the geopolitical realignment to physical commodity flows, those forces did not disappear when the price fell. They got stronger. Silver being stuck at $72 isn't a mystery. It's a loading screen. And if you understand what's loading behind it, you won't be shocked when it moves. If this video helped you understand what's actually happening in silver right now, smash that like button and subscribe. Drop your silver price prediction for end of 2026 in the comments. I rate every single one, and I'll see you in the next video.